absolutely characterized year on year by the depression in two of the markets for two of our businesses. The first being diamonds, as you mentioned, and the second being our PGM business. And pretty much in both of those businesses, we saw real weak demand and very low pricing. The consequence of which is the change from earnings from 2023 to 22 to 23 is almost entirely described by the fall in those two markets.
The effect of high inflation also mentioned in some of the numbers. To what extent is that now in the rearview mirror as we see some disinflationary trends kicking in?
No, well, look, I mean, inflation certainly has not gone away, and certainly not for this industry. I mean, it is true to say that it's not increasing at the rate that it was before, but many of the inflationary-driven cost increases that moved into the business during the course of last year remain in the business itself. So, you know, the elasticity of the removal of some of those costs is yet to be seen. So the businesses are all still having to cope with slightly higher costs, which is exactly what happened during the course of last year, and which is really why we still have a very deep focus on cost management.
Duncan, the conundrum is the following sentence from yourself in your statement. There is no doubt that the immediate macro picture presents some challenges, as you mentioned, for PGMs and diamonds. But this next bit I'm very interested in. The demand for metals and minerals has rarely looked better. Do you want to just break that down for us? Yes, absolutely, and with pleasure. I mean, I think, you know, we've got to separate the view of the short term versus the view of the long run. And there's three major demand-themed trends that I think are playing over the mining industry specifically at this particular point in time. And they are very difficult from a fundamental point of view to extract yourself from without really believing that there must be some fundamental demand drivers that are very good for the type of industry that we're in today. And first of all, the first one of those is the eradication of poverty and the improvement of people's lives. I mean, this is typically what mining metals and minerals have done all of their life over the last 100 years or so. That's how you get cars, that's how you get air conditioners in your homes, that's how you get your homes built generally, etc., etc. And the world is going to want to continue to improve its living standards. And if you just took two of those metals, iron ore and copper, for instance, if you compared the intensity of use in the developing countries to those in the developed countries, you would conclude that you'd need about 4 times more metal to cover the delta between the developed and the developing countries. So that's just one trend. The second is this energy transition, right? That's not going away anytime soon, and that's going to be very intensive in terms of the metals and minerals that is needed. And one of the factoids that I've used in the past before is that you would need like 60 more mines the size of Quellaveco to deliver the copper into that energy transition. So very positive. Very positive, and yet very negative share price, I'm afraid, down up today. So positive, they're taking what you're saying today positively, but down nearly 50% over the last 12 months and significantly off your highs. Can the self-help you're talking about today, with nothing off the table in terms of your look at the portfolio, can that make much ground in readdressing the share price performance without a recovery in China? Well, yes. Look, I mean, you know, our strategy is focused on 3 key things. The first of those is self-help in terms of cost and cost management and improvement, and that gets us to operational excellence. So it doesn't matter what asset that you have in the portfolio; they all have to be extremely well run and extremely well managed at the bottom of cycles just as much as at the top of cycles. The second is a genuine portfolio review and an understanding of, you know, what assets are in the portfolio, what role they play in the portfolio, you know, what their markets look like, and that's a process that we're undergoing at the moment. And then thirdly, that then puts us up into a great position to execute on some of the growth optionality that we have embedded within the portfolio in those commodities that are in the right markets.